Greetings and thank you for joining us. I'm Dave Yeske and I'm looking forward to spending the next 30 or 40 minutes reviewing some of the economic and financial elements of this coronavirus pandemic we've all been living through now for 100 days or something like that. So what my plan is to talk a little bit about the latest economic impact of the pandemic, the latest state of the pandemic, review some of the global governmental responses, both fiscal and monetary responses here in Europe and elsewhere. And then I want to revisit something that I touched upon in our first coronavirus economics webinar, and that is the different shapes that recovery might take. And I've added a few new ones, and that I think that there's an interesting story to be told around those. And finally, I'm going to be addressing something. I've been getting a lot of questions, and it's something that's been in the news quite a bit, about this idea of there being a disconnect between what's going on in the stock market and what's going on in the real economy. And so we're going to spend a little bit of time talking about, first of all, what's happening, what that disconnect looks like, and then secondly, talk about some of a couple of the possible mechanisms that might explain that so-called disconnect. In fact, may even explain it away. Maybe it isn't a disconnect, but we'll talk about that a little later. So for now, let's start with the state of the pandemic. In the US now, we're about 2.2 million infections and about 119,000 deaths. If you look at the charts on the right, those are both for the US. You can see, obviously, they're very choppy. It's very highly variable from one day to the next and 1 week to the next. But what you can see is through all those ups and downs, it looks like the rate of new daily infections is fairly stable right now. It would be nice if it was continuing to fall, but it seems to, over the course of the last 4 or 5 weeks, it appears to be, through all those little ups and downs, it appears to be kind of flat, stable at a rate of, something like 20 plus or minus 20,000 a day. The chart at the bottom shows the deaths, the daily deaths. And fortunately, there's been a downward trend in that. Even though, again, it's very choppy, you can see that the successive peaks are lower and the successive valleys are lower. So the overall, if you were to draw a trend line there, you would see that it's sloping downward and it's continuing to fall. And we can only hope that that continues to be the case. I'm not an epidemiologist, and I don't play one on I don't even play one on TV. But I'm going to guess that in the face of a sort of a constant state of new infections on a daily basis, the fact that the daily death rates continue to drop can only be a factor of improved treatment and improved therapies, that the medical establishment is getting better at knowing when and how to intervene. And obviously there are new therapies that are coming into play every day. And again, we can only hope that that trend continues. Worldwide, we have had 8 million infections and 440,000 deaths. If you compare the global economy with the US economy, you can see that deaths in the US are disproportionately high. But I think some of that may be due to the fact that there are a number of regions and countries that are at an earlier stage than we are. So that'll be something for us to watch. But now let's move on to the realm where I'm more comfortable, and that is talking about the economy. You can see this is a chart of weekly unemployment claims. And after having peaked in late March, it's been pretty steadily falling ever since. And currently, weekly unemployment claims are running somewhere around 1.5 million new claims per week, which is as a trend. I mean, you could just look at the chart and you can see that as a trend, that looks good. 1.5 million people, losing their jobs on a weekly basis as an absolute number is horrific. So we can only, hang our hopes on the trend and hope that continues. One thing that was interesting I found is if you look at the continuing unemployment claims, something that emerged, about 6 weeks ago was this, that even though we had 1.5 to 2 million new claims for unemployment each week, the actual number of people on unemployment started falling. And so what that's telling us is that even in the face of new unemployment claims, people are getting jobs. And so in the most recent week, here's an example. There were, 1.25 million new jobs in leisure and hospitality. There were almost 500,000 new jobs in construction, 400,000 in healthcare, almost 400,000 in retail trade. So, and manufacturing added 225,000. So even though new claims for unemployment are rising, we're finding that more people are getting jobs. So the number of people on unemployment appears to be falling, along with the number of new claims for unemployment. Again, these numbers are huge. The number of people currently unemployed, it's over 20 million people. That's huge. The number of people going on unemployment each week at, plus or minus 1.5 million, that's huge. These as absolute numbers, these are enormous. To give it some scale, you can remember that all through the Obama administration, when we were recovering from the Great Recession, and then into the Trump administration, we would get these new jobs numbers, and the numbers would be, you'd get 200,000 new jobs, and 100 to 200,000 was a number that was meaningful. And now we're dealing in millions. So the absolute numbers are horrible, but the trends are good, and so we can only hope those trends continue. Now you can see this is in the last presentation we did. This was showing what happened in the first quarter with the gross domestic product, that is the size of the economy. And what it boils down to is the economy fell about 5%, shrank about 5% in the first quarter. And that was the largest drop since 2008, largest drop in over a decade. So that was a pretty significant number. Well, the number is now in, well, or at least the official number is not in, but we have some pretty good estimates of what it is. And this is based on the Atlanta Fed. And the Atlanta Fed is now this, I took their worst case estimate, but they're estimating that at an annualized rate, that the economy will have fallen almost 50% in the second quarter. So two things to say about this. I did take their worst case scenario. I've seen a number of analyses that suggest that when the real numbers come in, it'd probably be closer to 40%. I'm going to hope that's true. But even 40% is a horrific shrinkage. One thing I want to emphasize, because we're all looking at these numbers, and when the official numbers come out, they're going to be splashed all over the front page of your newspaper. This is an annualized number. This is not how much the economy shrank in the second quarter. The economy shrank something like between 20 and 25% in the first quarter, and it shrank 15 plus or minus percent in the second quarter, and that would annualize to 50%. Okay, but that's not what it actually dropped. Now, because there's expected to be the conference board is actually estimating that the third quarter will show a 30% gain, that the economy will grow by 30%, which will be quite a bounce back, and that the year as a whole the economy will shrink. This is in the U.S. that for the year as a whole, the economy will shrink about 6%. Now that's still very substantial, but it's nothing as scary as this annualized number looks. But it shows the depth of the impact in the short term in the second quarter. Fortunately, before the end of the second quarter, we were beginning to climb out. I will just mention, just to give you some global perspective, that the International Monetary Fund is currently estimating that emerging markets for the year, for 2020, their economies will shrink about 1%, that the developed economies, obviously this is the US, Japan, the European Union, and the UK, Australia, that they will shrink about 6%. So the US is very much in line with what the IMF expects for the rest of the developed world. And that the world as a whole, the global economy will shrink by about 3%. So that'll be something to watch. But all of that assumes that there'll be a dramatic bounce back in the third quarter, and then some moderated, probably much more moderate growth in the fourth quarter. Again, what we're looking at here is, I mean, this is like behind us. The second quarter is behind us now. So what we're going to be looking for are the emerging trends going forward and trying to draw conclusions from those. One of those trends were the numbers that we saw in retail sales. Retail sales were up basically 18% in May, which was a huge rebound from where it was in April. So this is something that is a really good sign that that consumers continued to spend and ramped up their spending once the initial shock of the shutdown and the quarantining had settled in. Consumers adapted and companies adapted, and retail sales were back up again. They're still well below their prior trend, or their prior level, I should say. But the trend, again, we're always looking at trends. The trend is quite positive, and in fact, the stock market took this as a very positive sign as well. And I'll have more to say about that later. So let's review what's been going on in terms of governmental responses in the U.S. and around the world. The U.S. Congress responded very powerfully with fiscal support. And many of you have heard me say, I don't call it fiscal stimulus because it was less about stimulating the economy and more about supporting the economy. Making sure that the pipes were still open so that when things started to open up again, more companies would have survived. The concept being that companies that but for the pandemic would have been viable, survived long enough to be viable again post-pandemic, or at least not, if not post-pandemic, post-total shutdown, once things begin to incrementally open up. Now, there's wide belief, including by the Federal Reserve Chair Jay Powell, that $3 trillion of support, of fiscal support that Congress and the White House approved was great, was actually utterly unprecedented in history in terms of level of support, but by itself is not enough. That more will be needed. Now, the House of Representatives has developed a bill, that proposes another $3 trillion of additional fiscal support, and a lot of this next round is aimed at state and local governments. One of the things about state and local governments is that unlike the federal government, they cannot run deficits. They have to balance the books, which means that all of a sudden when their sources of revenue plummet, which they have, as you might imagine, fewer sales tax, fewer property taxes, fewer business income taxes, all of these things, when those sources of revenue plummet, they have to balance the books. And how do they balance the books? Well, they balance the books by laying off employees. The thing I didn't show you on that earlier chart that showed 1.25 million new jobs in hospitality and so forth was that there was, I think, 500,000 or 600,000 jobs lost in government. And most of that was at the state and local level because, again, they have to balance their books. Their revenue is plummeting, and therefore they have to start furloughing people and cutting jobs. And you don't want them to have to cut to the bone. You don't want them to have to cut first responders and medical professionals. And so the House of Representatives, this next round, the total is $3 trillion. It includes additional support for individuals, additional support for small business and medium-sized business, but it has a much larger contribution towards supporting state and local governments so that we can stem that loss of jobs in those first responders and other government employees. The White House has proposed $1 to $3 trillion in infrastructure spending. This has been on the table for a long time. Honestly, by the time it got to the front burner a few years ago, it was almost too late in the context of the Great Recession. At the beginning of the Great Recession, there was a lot of talk about infrastructure spending, and it really never happened, or very little of it happened. And then by the time it had moved to the front burner in 2017, we had 4% unemployment rate, and it's like, where are you going to get the workers for all these new construction jobs? But now, with an unemployment rate in double digits and expected to end the year at least close to double digits, I think the best estimate I've seen is somewhere around 9%. There's actually lots of slack in the labor force, and significant infrastructure spending could actually do a lot of good. So with the White House in favor of that, I'm thinking the House of Representatives could very readily be talked into that. You know, the ball is probably going to end up in the Senate, and we'll see where they go with that. But so that'll be something to watch very carefully. What does the Senate do with the current $3 trillion bill that the House has recently passed, and what do they do with $1 to $3 trillion worth of infrastructure spending that the White House is proposing, and that will likely find support in the House? The Federal Reserve, you know, I said the U.S. Congress, you know, in terms of fiscal support, showed up big, showed up in a way, at least initially, that was of a size commensurate to the size of the problem, and it's really commendable and impressive. The Federal Reserve showed up early and often and showed up big, and Jay Powell is to be commended. He was an amazing leader. The Fed showed up sooner than they did during the Great Recession, and they showed up bigger. And, you know, they immediately moved the Fed funds rate to zero, which is, say, short-term interest rates to zero. They had been shrinking their balance sheet. You know, the Fed had engaged post Great Recession. They'd engaged in a thing called quantitative easing, and it's where they're actively buying bonds. And they're out there buying bonds as a way of keeping interest rates low, longer-term interest rates low. The thing about the bond market is, if you have an active buyer that's driving prices up, when the prices of bonds go up, the yields go down. So with the Fed actively buying bonds and driving prices up, they were driving interest rates, longer-term interest rates down and keeping them there. Well, in more recent years, when the economy seemed to be on firmer ground, the Fed had started shrinking its balance sheet. It had stopped rolling over bonds. It had just let them mature. It had stopped buying, well, first it stopped buying bonds, and then it stopped rolling over the bonds in its portfolio. So its balance sheet was shrinking. At the outset of this pandemic, 3 months ago, the Fed stepped back in and ramped up its bond buying, and essentially is saying indefinitely. I mean, I really am impressed by the leadership that Jay Powell has shown as chair of the Fed. He was quoted, you know, 5 or 6 weeks ago when someone was questioning, you know, how much monetary support they were prepared to bring to bear on the problem. Chair Powell basically said, you know, it's not a limited pot, and it's not. As I discussed in our last webinar, which was devoted entirely to monetary and fiscal support in the midst of pandemic, I noted that in a very real sense, there's no theoretical limit to how much the government can borrow and how much the Fed can print money. I mean, there just isn't. You know, the practical limits come around the impact of inflation. If it becomes inflationary, that starts to put some pressure on the government's borrowing and on the Fed's money creation. But we are so far from that at this point. I mean, the Federal Reserve is still trying to get the inflation rate up to 2%. It barely ever succeeded in the 10 years following the Great Recession, and there's really no reason to think that they're going to do so anytime in the near term. They are again worried about deflation. In fact, we actually in Japan right now, they're experiencing deflation, and deflation is when prices not only don't rise, they actually shrink. So that $30,000 car this year is only going to cost you $29,000 next year and $28,000 the year after, and so forth. And in fact, that's one of the reasons deflation is bad, is it discourages business investment and it discourages consumer spending. If you're a consumer and you're proposing to buy a $30,000 car this year and you think, you know, if I wait 6 or 12 months, I can get this same car for $29,000, you know, you might decide to wait. Well, since consumer spending is 2/3 of economic activity, if consumers start waiting and deferring purchases, all of a sudden the economy starts to shrink, and then people start losing their jobs, and then the economy shrinks further, and you get this downward spiral. So a little bit of inflation is actually a healthy thing. It encourages people to make a different kind of decision. Anyway, so the Fed moved interest rates to zero with basically what they call forward guidance, saying that it's going to be zero for a long time. It's going to be zero for as long as it needs to be zero. They then ramped up their quantitative easing again. They started buying bonds. You know, the U.S. government to date this year, I think, has issued about $1.6 trillion worth of bonds, and the Fed has bought more than that much in bonds in the open market. So for all practical purposes, the Fed has bought everything the government has spent, all the bonds the government has issued to support its deficit spending in this crisis. So, there's kind of an interesting partnership there. Again, when you worry about the impact of the government issuing a lot of debt, the Fed can basically buy as much debt as the government can issue. And there's an interesting point. I brought it up in our last webinar on that was again focused on monetary and fiscal policy. What a lot of people don't realize is that the government, the Fed has a huge balance sheet of bonds, and it's getting bigger by the day at this point. And they collect interest on all those bonds. They're holding those bonds on their balance sheet. They collect the interest. What a lot of people don't realize is after expenses, they remit all the net interest to the Treasury. So there's kind of a cyclical thing where the Treasury issues a bond, the Fed buys the bond, the Treasury pays interest on the bond, and the Fed remits the interest back to the Treasury. So, that's an example of the kind of capacity that exists for the government to really show up big. So I'll move on. The Federal Reserve also had a Main Street lending program. The CARES Act, which Congress passed, and the Paycheck Protection Program, and the EIDL, which is the emergency lending to small business, they were all focused on smaller businesses with fewer than 500 employees. The Main Street lending program is aimed at lending to businesses that are too big to qualify for things like the Paycheck Protection Program, but too small to have access to the capital markets. A big Fortune 500 company, they can issue stocks and bonds and borrow money to a significant degree, even in the midst of a major downturn like we're in now. But there's a middle ground of companies that are too big to qualify for small business support, but too small to have that kind of access to the capital markets. And the Fed is stepping in to try and help those companies in the middle. This is the Main Street lending program. And finally, the Fed is committed to financing state and local governments. So they're actually committing to buying the bonds that are issued by state and local governments as a way of making it easier for them to finance their spending needs. And again, this is one of the things that Jay Powell has been saying, and we're going to talk more about, well, I think we're going to talk about this maybe in one slide, is that notwithstanding the fact that there's some early indications that the economy is beginning to bounce back, that the Fed can only do so much. There's still a significant need for fiscal support, more fiscal support going forward, and that the Fed is not necessarily the best instrument, the best institution to do that. The Fed knows how to support the money markets, and the Fed knows how to support financial institutions. The Fed is not best suited for supporting businesses and state and local governments. Really, the federal government is best suited to that. And so Chairman Powell has been significantly, has been telling Congress to a significant degree, you really are not done yet. So before moving on, let's talk about the European Union. Now, the European Central Bank was a key player in helping to mitigate the impact of the Great Recession and the carry-on effects after. And it was also engaging in quantitative easing. It was out buying bonds and so forth. And you could see that the European Central Bank is committed to actually negative interest rates, not just zero interest rates, but negative interest rates. You actually end up paying them for the privilege of holding, euro-denominated bonds, and more quantitative easing. And they've actually committed to like 1.5 trillion euros worth of this kind of support. And unusually, we didn't see this in the aftermath of the Great Recession. There's also a commitment by the European Union to a half a trillion euros in fiscal support, and that includes fiscal support to individual countries that may be suffering as a consequence of this pandemic. This is what I was talking about a minute ago. Jay Powell, chairman of the Fed, he was testifying in the House of Representatives a few days ago, and he was saying it would be a concern if Congress were to pull back from the support it's providing too quickly. He went on to say it would be wise to look at ways to continue to support people who are out of work and also smaller businesses that may not have the vast resources for a period of time, so that we can get through this critical phase. That support will be well placed. So he's been very clear that what the federal government has done in the way of fiscal support to date is wonderful. and it's not enough and it's not done. And part of what he's doing, part of why this is his message, is because while the House of Representatives is very focused on continuing fiscal support, as I said, they've already passed a bill that is worth another $3 trillion. Senate Republicans seem to be taking the wait and see position, saying, well, let's wait for a while. Let's wait and see what the impact of the last round of support is before we do another round of support. And Chairman Powell is saying, no, don't do that. Don't do that. That last round of support was wonderful. It's not enough. More is needed. Please don't take a wait and see attitude. So he's front and center with his messaging on that. And I appreciate the fact, I mean, he comes from a conservative background. Chairman Powell was appointed by President Trump. So hopefully that gives him some bona fides to be going forward with this message. And I hope that the Senate Republicans are listening to him. So now the question that comes up again and again and again is, well, with the government borrowing record amounts, with the government spending, having trillions of dollars of deficit spending, and the Federal Reserve buying trillions of dollars worth of bonds, keeping interest rates at zero, expanding the money supply, what is this? How is this going to affect interest rates and inflation? Because traditional, again, my background is economics. And when I was first in graduate school studying economics, 30 years ago, if the models that we were studying then would have said this level of spending, this level of borrowing, this level of money creation would absolutely spike interest rates. It would spike inflation. This was the received wisdom, and no one could conceive of, really back then the models couldn't conceive of the world we're living in now. So because you have to look all the way back to World War II to get kind of anything of the same magnitude, if you look at the US debt following World War II, it was of a magnitude that we're heading for now, where the US debt was actually larger than the annual output of the economy. And this, by the way, has been true for many years in Japan. And interestingly, it has not created inflation there. As I said, they're currently experiencing deflation. But anyway, what happened was that the Federal Reserve then had a triple mandate. You often hear about the Federal Reserve having a dual mandate, and the dual mandate is to control inflation, often referred to as prices, control prices in a way that's consistent with full employment. So basically, try not to let inflation get out of hand, but don't be so aggressive on inflation that you create a lot of unemployment. And it's quite a balancing act. And in fact, again, back 30 years ago when I was first in graduate school, there was a thing called the J curve, which would suggest that there's a certain threshold of unemployment below which you'd start to spike inflation. And we got well below that threshold in the last couple of years, and with no incipient inflation. But anyway, back then the Fed had a triple mandate. The dual mandate was part of that, to control inflation consistent with full employment. But the third element of their third mandate was to support the national debt. And the way they supported the national debt was through a process called financial suppression. And so the Fed artificially kept interest rates very low for years after the Second World War as a way of allowing the federal government to manage its debt, without the cost of debt service getting out of control. I saw an analysis that said that financial suppression in the context of the U.S. and actually globally, it was going on elsewhere as well, had actually been equal to 1 to 5% of gross domestic product in terms of the economic savings. So this was what was going on. And although theoretically we could grow our way out of the current surge in debt, financial suppression is the more likely path. And I can tell you that this makes a lot of people, at one level, this makes a lot of people unhappy. I spent this past weekend with my father. I live in San Francisco most of the time. My dad lives in Napa, and I spent this last weekend with him. We were socially distancing. We spent our time on the deck, and then he'd built an apartment on the top of his barn, so I slept in the apartment on top of the barn. So we were able to social distance and spend a couple of days just chewing the fat. And my father, he invests in, like a lot of people, like a lot of retirees, he invests most of his money in interest-bearing instruments, CDs and money market funds and things like that. And so he's tremendously unhappy with the long-standing situation in the U.S. economy where we have super low interest rates, where you're lucky. I mean, the 10-year Treasury bond right now has a yield of 0.7%, which is actually, that happened recently, and it's the first time maybe ever that the 10-year Treasury has had a yield under 1%. And so for those who are living on interest income, it's been a really rough 10 years ever since the Great Recession. And just as it started to look better, over the course of the last year or two, interest rates were starting to rise again. All of a sudden, it's back to zero, and you're lucky to get you could barely get 1% on anything. So he's really unhappy about that. And I think that a large part of our population, a large part of the global population, I'm sure, is also unhappy. But it's one of those things where, in order to rescue the larger economy, in order to keep businesses alive and keep jobs, this is the path that we have to follow, or the policymakers have to follow. And so, again, I think my father is like a lot of people, probably a very significant proportion of the population, who thinks it's a little bit of a rigged game, that these low interest rates are just meant to juice up the stock market, and that it's good for stock market investors and no one else. And honestly, as we'll discuss in a few minutes, it does have that consequence. It does help the stock market, all other things being equal. But I'm confident that the Federal Reserve is not acting with that in mind. The Federal Reserve is not doing what they're doing specifically to juice up the stock market. They're doing it for other reasons. They're doing it to rescue the rest of the economy. So I saw an interesting quote yesterday. The newly installed chief economist of the World Bank, Carmen Reinhart, said, "You're talking to a very fiscally conservative person," when talking about the size and magnitude of government debt and the deficit spending. Said, "You're talking to a very fiscally conservative person, but this is war. In a war, you worry about winning the war. Then you worry about paying for it." And that's absolutely the attitude of the US Fed. It's the attitude of the European Central Bank. And recently, it's been the attitude of the federal government and the EU and the Japanese government and the Australian government. And honestly, in my opinion, we can only hope that attitude continues. When you want to talk about inflation, inflation is not an issue when you have double-digit unemployment, and when you have that much slack in the economy, inflation would be basically impossible. So, at the point where we start to see some inflation, you should be celebrating, because the point at which we see some inflation is the point at which the slack in the economy has disappeared. It's the point at which unemployment rate is again low, when everyone who wants a job has a job, and the economy is chugging along at a positive rate of growth. At that point, we might see some inflation, but not before. So I, for one, am going to worry about fighting inflation when we see some, because at that point, I know the rest of the economy is going to be healthy. So now I want to revisit something that we touched upon in our first coronavirus economics webinar, and that is the path the different recoveries can follow. And a lot of you were on that webinar, and a lot of you have watched a recording of it. So I'm not going to spend a huge amount of time here, but I do want to revisit. So there's a typical V-shaped recovery that follows what's known as a real recession, and it's a recession that occurs. It's often a recession historically that's been caused by the Federal Reserve, and it's one where there's a sharp drop in the rate of economic activity and an equally sharp recovery right back to the original growth path that the economy was on. Now, when the Fed, for example, the Fed did this back in 1990. Pardon me. 1982, when then Chair Paul Volcker was determined to break the back of inflation now once and for all. And so he really shrank the money supply, spiked interest rates, the level of economic activity contracted sharply. It was a very sharp and deep recession. But then they eased off very quickly, and within a year, the economy had returned to its prior growth path. So it was a very short, sharp recession, but it bounced back and gave us this V-shaped recovery. And the Fed did the same thing in 1994 when they were worried about incipient inflation, and they raised the interest rates, I think, 7 times over the course of 11 months. And the economy went into a recession, and the stock market fell and the bond market fell. And then they eased off, and we had, an incredible bounce back in the economy, a bounce back in the markets. The Dow Jones, the S&P 500 was up 37.5% in 1995. So that's where you get a V-shaped recovery in many cases, where whether it's caused by the Fed or something else, it's a short duration shock that the economy can recover from. And then you have a U-shaped recovery, and that's typical of a financial crisis. And this is something that we saw with the Great Recession 10 years ago. And that's where there were imbalances that have built up in the economy, an excess of debt on household balance sheets, an excess of debt on company balance sheets. There was a lot of bad debt in the system. There were a lot of mortgage-backed securities that had lost their value, that banks were carrying on their books, and that were causing banks to not want to lend. And a financial crisis like that, it takes time to unwind. Households have to rebuild their balance sheet. They have to pay down debt. And the only way households can pay down debt is if they're taking on less debt and they're spending less. And so consumer spending was depressed while they paid down debt. And banks had to get all this bad paper, these bad mortgage-backed securities off their balance sheets. And so that took some time. And so banks were less willing to lend during that period of time. And so it takes a while for this imbalance to unwind. And so you get the U-shaped recovery where you get a sharp drop. And then the economy returns to a growth path, but that growth path may be below its prior growth path. So it's back to growing, but it never made it back to the prior path it was on. And that's very much what we saw post-Great Recession. And then you have the L-shaped recovery. That's a worst case scenario. We're not going to see that in the US. One example of that was, after the Great Recession, in the aftermath of the Great Recession, you had things like the Greek debt crisis. And, there was a steep recession in Greece, and they bottomed out, but then they kind of went sideways for years and years and years. That's very much a worst case scenario. Again, we're not going to see that. But so we've covered all 3 of these in our first onto 2 other possible paths of recovery. And the first is the W-shaped path. And this is sometimes known as a double dip recession. Now, a double dip recession can be caused by a number of things. We've been talking about the Great Recession. Back in the early aftermath of the Great Recession, we had, in the US, we had Ben Bernanke heading the Federal Reserve. And the Ben Bernanke was also an incredible leader. He was, we were blessed to have him at the helm because he's arguably the world's greatest scholar on the Great Depression. And so when the Great Recession struck, he understood the magnitude of the problem and the potential risks. And so he was very expansionary at the Fed, and he stayed that way. In fact, continued to get more expansionary with the quantitative easing and the bond buying and all of that. Well, and he resisted a lot of political pressure from Congress. A lot of members of Congress and a lot of economists were worried about inflation as a consequence of how expansionary the Fed was in the immediate aftermath of the Great Recession. Well, it turned out they were wrong. It turned out that there was no inflation risk, and Ben Bernanke saw it, and he was able to resist that political pressure. And the U.S., as a consequence, after April of 2009, the U.S. economy started growing, and it grew pretty steadily, really until the second quarter of this year. But in Europe, the European Central Bank and European parliaments succumbed to the political pressure, and they pulled in their horns prematurely. And even though they'd been pulling out of the Great Recession, they went right back into recession. So that was a double dip recession that was caused by fiscal and monetary support being withdrawn prematurely in the face of an economic shock. So that's one cause of a double dip recession. And we saw it in Europe in the aftermath of the Great Recession. Another cause, and the greatest risk for us today, is a health-driven one. You know, a lot of people have been talking about the risks of a second wave of coronavirus infections. Now, of course, a second wave of infections requires that we exit the first wave, which we have not yet done. But assuming that in the next few months we can sort of move out of this first wave of infections and have a further opening of the economy, the risk is that in the fall we'll get a second wave of infections, and that will cause a renewed need to lock the economy down. Economic activity will again plunge, and it will send us into a second dip, a second recession, I should say. And you can see from the shape of this why it's called, a double dip recession. You can see why it's called, why it has a W shape. And so that's a possibility, and that's a health-driven possibility. So what that's going to, in terms of what you should be looking for, the thing you're going to want to watch is whether or not we get out of this first wave, and whether or not people act, whether or not your fellow citizens, as we start to open up the economy, act responsibly and engage in social distancing and wear their masks when they're in public. And if we get a lot of good behavior, there's a chance that we can avoid this health-driven double dip recession, this W-shaped path. And the other path that we've been discussing recently is what people are calling the swoosh. And they're calling it the swoosh because it's, as you look at it, you can see it's kind of shaped like the Nike logo, the swoosh of the Nike logo. And I call this the stretched V, because unlike the U-shaped recession where you have a sharp drop and then the economy resumes a growth path, but a growth path that's lower than the prior growth path, with the swoop, you get back to the prior growth path, but you don't get there right away the way you do with a V. It takes a while. It takes a year or two, maybe, to get back to that prior growth path, and that's what gives it that swoop shape. And that's why I call it the stretched V. And honestly, I think this is becoming the most likely scenario. And if you start to follow a lot of major economists who are serious economists who are following this, more and more of them are talking about the swoosh as being perhaps the most likely path that we're on. Having said that, this was just from a couple of days ago in the Wall Street Journal. They're already talking about a V-shaped, maybe a V-shaped recovery. And this was greatly influenced by the fact that the trends have been so positive in terms of unemployment, with reduced rates of new claims and with new jobs actually being created that are reducing that are of large enough magnitude that they're actually reducing the ongoing claims. And then that 18% spike in retail sales in May. All of these things have caused some people at the Journal to use the V word again. So I'm not going to do that. I just wanted to point this out that it's out there. Honestly, if you ask me to put odds on those 5 different shapes of recovery, I'd probably put the highest odds on the swoosh right now, on the stretched V, which I don't think is a particularly bad scenario for us. So the key drivers of this path, I've already mentioned most of this. I mean, the key drivers are how successful states are at reopening their economies and doing so in a phased and reasonable, in a phased and data-driven way. It's going to depend on continued monetary and fiscal support. Again, this is why Chairman Powell has been so out there in his testimony to Congress, in his public comments, in speeches, saying that the CARES Act and the PPP and the rest are not enough. We need more. We need ongoing fiscal support. And so whether or not I'm pretty confident we're going to get continued monetary support. Jay Powell is very clear about that. I think the big question mark, and so the thing for you to watch, the leading indicator for you to watch, is what Congress and the White House do. The health and the health related matters, as I said, the second wave of infection. If we exit this first wave and then we get bad behavior on the part of governments, state and local governments, or we get bad behavior on the part of our fellow citizens, and we get a spike of new infections, we get that second wave, that will be a big predictor of the shape of recovery, and will probably send us into a W-shaped recovery. Obviously the emergence of vaccines and other therapies. And again, I'm not an epidemiologist, but I sure am an interested consumer of everything they have to say. It's interesting. I was interested to note the other day, last week, that there are 7 promising vaccines that will actually be moving into phase 3 trials, which is the final trial before they're made, available to the public, moving into phase 3 trials as early as July. So I find that very encouraging. And then there are also therapies that are not vaccines. They're antibody therapies that you're starting to see a lot of news about, which are things that can be injected in a prophylactic way or as a way as an early treatment for infections. Again, I'm not playing an epidemiologist, but I am reading enough to see that there are a few promising vaccines and therapies that are emerging, and emerging faster than they have in the past. So I'm really only flagging that as something to watch. And finally, the final element to watch, the final key driver. I call these key drivers because if you almost created a dashboard for yourself and you had these 5, if you had like 5 needles on your dashboard that you could look at every day or every week, that would give you an indication of where we stood with respect to each of these key drivers, you could have some sense of what the path of recovery would look like. The final one is going to be the ability of companies and workers to adapt to our new normal. The ability of companies and workers to resume their prior activity in a way that compensated for the risks of COVID-19. And we're starting to see some of those. Elisa and I are a member of the University Club, and our social club is just actually 3 doors down from our apartment. And they started doing takeout dining from the kitchen. And so we've a couple of nights a week, we've had dinners where I would walk up to the front door of the club and Noel would walk up and hand me my dinner. And you could even get their signature cocktail of the week. And what they just initiated on Monday was outdoor dining. There's an alley between the squash facility and the clubhouse, and they've set up tables in the alley, and they're doing now outdoor dining, which is deemed under the right circumstances and with proper distancing to be relatively safe. And so later this week, I look forward to experiencing some outdoor dining. A number of restaurants across the country have started doing that. So we'll just see stage by stage as we have these phased openings, how well companies and consumers adapt to that. And also how optimistic people choose to be, whether or not they resume their prior spending levels, or whether or not they keep their, consumers keep their horns pulled in and focus on spending and building up reserves. The retail sales report for May suggests that, that maybe consumers won't be as cautious as some had feared, but only time will tell. So this is one more key factor, key driver for you to track. Now we'll come to the third and maybe in some ways the biggest element of today's discussion, and that is something that I've had a lot of questions about, that we've seen headlines on this topic, and that is the so-called disconnect between the stock market and the real economy, or as this little image from the cover of The Economist shows, the disconnect between Wall Street and Main Street. And so, I'll start by saying, what are they talking about when they talk about the disconnect between the real economy and the markets? And it's basically this. Those who are raising this question are saying, how can you have this at the same time that you have this? How can you have this incredible rise in the global stock market post March 23rd, while at the same time you have an annualized drop in the gross domestic product of 40 or 50% in the second quarter? How can those two things go together? And so, it's a very, it's an obvious question to ask. Because what you see is the headlines side by side, right? Market sets, market was up 1,600 points today. Oh, the economy, the gross domestic product is down 40% this quarter. You see those headlines side by side, and you say, how can this be? Well, there's a couple of things, a couple of factors that I want to discuss, but maybe the biggest one is a deep underlying one. And I think this is what the market this might be the stock market's reply to The Economist. Maybe I know something you don't know. I mean, this is the fundamental truth about markets, is that if you think about the stock market in any way at all, you should think of it as an information processing mechanism. First of all, the stock market it's not a machine, it's a social construct. It is millions and millions of individuals and institutions coming together to buy and sell, to trade stocks between themselves. And they all trade, they all have information that they've developed. And they all show up with their non-overlapping bits of information that are either driving them to sell or to buy. And sooner or later, prices will settle out at some equilibrium price that represents a price that seems fair to both buyers and sellers, that represents their best estimate of future prospects. And so those prices become very information dense. And so as an information processing machine, you have, that's what the market does. Now, new information shows up every day. So sometimes we have these wild swings in the market, but oftentimes it's because it's processing new information. And you can get tipping points where the aggregate expectations of investors crosses some threshold where it may shift dramatically and be more pessimistic or more optimistic. And then you get significant breaks in value where prices may go up or down very dramatically. These things can happen, but over time and on average, the market is just trying to find a balance where all the buyers and all the sellers think that the current price is kind of a fair price at which to sell and a fair price at which to buy. And this is so-called equilibrium. And the other thing to remember is that when markets are doing this, they're not doing it based on what's going on today. They're not doing it based on those side-by-side headlines you're seeing. They're not doing it based on what the economy did last quarter. They're doing it based on what the expectations are for the future. The markets are always focused on what's taking place out on the horizon. To give you one example, there've been a number of academic studies done that have tried to correlate stock market returns with with company earnings in the aggregate, which you could also relate that to economic growth because company earnings are a part of that. But what they've tried to do is they've tried to correlate stock market movements with corporate earnings. And for reasons we'll discuss in a minute, there should be a relationship between corporate earnings and stock market movements, because when you own a share of stock, basically what you own is you own a share of a company's earnings. And what they found is that in any given year, there's no correlation whatsoever between what the stock market is doing and what companies are earning. But there is a correlation, there's a lagged correlation. Stock market returns are correlated with next year's earnings. So if you looked at many years, if you looked at 20 years in a row, what you'd find is that this year's earnings are correlated with last year's moves in the stock market, which is to say the stock market anticipated this year's earnings. So that's just like a statistical demonstration of the fact that markets and investors, they don't care about what contemporaneous information, they care about what's going to happen next year and the year after and the year after that. Now, as a little bit of a side note, I'd like to just mention what's been going on in the markets over the course of the last month. And I think it's an interesting trend. I've said to a lot of people over the last year or so that it was kind of feeling like 1999 or 2000 to me. I've been around I'm kind of old. I've been around for a long time. I remember 1987 and Black Monday, the biggest single day drop in the market. And I remember the dot-com meltdown in 2000 and all that followed there. And I was advising clients all through the 90s. And one of the things that we saw in the 90s was the latter half of the 90s was all about growth stocks. It was, it's called the dot-com era, but it was really mostly about blue chip growth stocks. It was about Intel and Cisco and other big technology companies. It was about growth stocks in general. So the S&P 500, which came to be very growth oriented, grew dramatically over the last half decade. And the NASDAQ, which was very tech heavy, grew dramatically over the last half of the 90s. And we were investing in the same way then that we did now. And so, we were dealing with the same conversation. We were having the same conversations in 99 and 2000 that we're having now. And that is, why are we investing in small company stocks? Why are we investing in value stocks? Why aren't we just putting everything in the S&P 500? Or why aren't we just putting everything in the NASDAQ or growth stocks or technology stocks in general? Well, nothing lasts forever. And one of the things that happened in 2000 when the bubble broke, or burst, I should say, bubbles burst, they don't break. When the bubble burst was that growth stocks and technology stocks plunged. Growth stocks in the US and abroad plunged by almost 20%. The NASDAQ fell by 40% in 2000. But our portfolios were actually up. They were in the black in 2000. And it was because those small company and value stocks came to the rescue. It was because domestic small company stocks and foreign small company stocks were up 20 to 30%. Real estate securities were up, bonds were up. And so those things buoyed our portfolio. And then when the recovery arrived at the end of 2002, those small company stocks took off like rocket ships. And between 2002 and the end of 2007, it was the small company stocks that were leading the way. So that's one thing that I think is worth remembering as we look at this particular investment strategy that we're taking, is that, yeah, you know what, the growth stocks and the S&P 500 have really kind of dominated in recent years, but that doesn't mean they're going to dominate forever. We've seen this pattern before. So I won't spend more time on that. I may do a whole presentation on that, but I just wanted to make a little side note. And you note here that small value, small value, international small, all of those emerging markets, pretty much every single category is doing better than the S&P 500. It's really interesting to see the S&P 500 at the bottom of the list, and at the bottom of the list by a lot. So now I want to come back to this question of this so-called disconnect between the market and the real economy. And to do that, we have to talk a little bit about how you even think about what a stock is worth. Now, when you buy a stock or a basket of stocks through a mutual fund, what do you get? Well, you get ownership of a company, but what that really gives you is ownership of a share of that company's earnings. This year, next year, and basically for as long as you own the stock. And so one of the ways of thinking about what a company's worth is to say, well, what are its earnings worth? And the traditional way of answering that question is to say, well, if I get $1 of earnings from the company today, it's worth $1. But if I get $1 of earnings a year from now, it's worth less than $1. There's this idea, there's this concept of present value, future value. There's this concept that if you promise to give me $1 a year from now, well, that's worth less than $1 to me today, because I can invest that money and earn something on it in the intervening year. So if you were to give me a trade-off, you were to say, well, I'll give you $1 a year from now, or I'll give you a lesser amount today. Well, if I thought I could earn 5%, I'd be willing to take 95 cents today. Because if I get 95 cents today and I can invest it at 5%, I'll essentially have $1 at the end of the year. It'll actually be 99.8 cents, but essentially I'll have $1 at the end of the year. So a company's earnings of $1 a year from now they're not worth $1, they're worth 95 cents if 5% is the relevant rate. And $1 received 2 years from now is worth even less, and so forth. So you can take all of the expected earnings and do that discount process and say, okay, well, so now I know what the value of all the future earnings are. This is what I'm willing to pay for the stock. So let's just put some actual numbers on it. If a company has $1 of earnings and the discount rate, the relevant, or the expected or required rate of return is 10%, well, you basically divide that $1 of earnings by 10%, 0.1, And you'd say, okay, that company is worth $10. That share is worth $10 to me. You know, essentially what you're saying is, I'm willing to pay $10 for $1 of earnings because I need a 10% return. Now, conversely, what that means is that if the relevant rate is less, if I only require 5%, then that same dollar of earnings is worth $20 to me. And so lower interest rates will support higher stock values. And of course, we all know interest rates are, I mean, at the short end, they're 0, and even the 10-year treasury is 0.7%, 0.7%. So the other way of looking at that is the competition. You know, if bonds are only yielding 1%, then I'm willing to pay a lot more for a stock in order to capture some of its earnings, because the alternative is paying me. The alternative being the bonds is paying me so little. So the real insight here is that when interest rates are low, when the rates of return on interest-based products like bonds are low, that, all other things being equal, that always supports a higher stock price. And so it's not surprising to see stock prices higher in the face of low interest rates. So that's one factor. Here's another factor. Let's revisit that swoosh. So let's just imagine that the swoosh is the path that the economic recovery follows. And so by extension, you know, if economic recovery, if the economic level of economic activity is following that swoosh, then that means that the earnings of the average company in the economy is also going to follow that same swoosh. And so if you look at the trajectory of earnings for ABC Inc., and you could see that what the swoosh would do to their earnings, they would fall, and then they would, over the course of a year or two, they would recover back to the prior trend line. So this is what we look at in the short run when we look at the impact on a company of the pandemic. We say, well, look, this company's earnings are going to be down in 2020. This company's earnings might be down in 2021. Well, that's how we might look at that's how we might look at it in the short run. But how does the market view this? This is how the market sees it. Yeah, the market sees the same swoosh, and it's a lot, and it doesn't see the swoosh in the context of, oh, what's happening this year and next. It sees the swoosh of what's happening this year and next in the context of the next 10, 20, 30, infinite number of years. Because it's all the future earnings that determine the current value of a stock, not this year's earnings. If it was only this year's earnings that determine the value of a stock, I mean, every stock in the market would be at 0. And the reason it's not is because the market is looking at all of these companies and saying, well, they're taking a big hit, but in the context of the long term, we think they're going to have a lot of earnings in the future. And all of those future earnings are embedded in today's price. So that's another way of looking at why the market might look the way it does, even though right now, this quarter or last quarter, we had something really nasty happen. You know, the market is just looking way beyond what happened last quarter. And that's the simplest explanation. And honestly, I think it's the truest explanation of why there's an apparent disconnect. The market cares about the future. And so you get juxtaposed headlines that seem jarring, but from the market perspective, they're just not. All right, so I've gone for over an hour, as I always seem to do. So I just want to quickly summarize. You know, the immediate impact, obviously, of COVID-19 and this pandemic has been of unprecedented magnitude. Fortunately, global governmental, monetary, and fiscal response has likewise been of unprecedented magnitude. The thing that's going to determine the path forward is human behavior. Economic behavior, which is to say, do people get back out there and do they start spending again? Do they start, you know, do they have confidence and optimism, and therefore they're spending money, they're buying products, they're buying services, they're going to restaurants, they're eating outdoors. If their economic activity returns to normal, and their hygienic activity, if they're also smart about managing their behavior in the context of the pandemic, if they wear a mask outside, if they social distance, if we get those two things, a return to optimism and optimistic economic behavior, and hygienic activity in the form of data-driven behavior in terms of social distancing and wearing masks. If we get those two things together, that could put us on a very attractive recovery path. And finally, just the point I was just making, markets don't care about what's going on today. They only care about what's going on tomorrow. And they move not based on what's going on today, but what's on the horizon. And so the markets may know something we don't. The markets collectively, the wisdom of crowds, if you will, may be telling us something about next year and the year after and the year after that we can't see with the blinders that we all individually and inevitably wear. And finally, in all things, mental, emotional, and financial, the best strategy for surviving in all those realms is resilience. Obviously, from a financial planning standpoint, we work with our clients to build resilience into their affairs, to have adequate emergency fund, to have adequate cash reserves, adequate stable reserves of cash and bonds if you're in a spending mode, the right types and amounts of insurance, that you're taking advantage of whatever benefits have rolled down the line through the course of this crisis, and that you're taking care of yourself, because we manage our finances through resilience, but we also manage our mental and emotional health and our finances through every form of resilience. And sitting still, stopping, breathing, that can build a lot of resilience as well. And that's one of the reasons we've had 2 guided public live meditation sessions, and we may do more in the future. Many of you participated, and I hope you enjoyed them. So we haven't had any questions so far, and I hope that that isn't because everyone dropped out. I hope if anything, it's because I've been tremendously clear in what I'm saying. But I've enjoyed spending time with you. This has been recorded. So if you have any friends, relatives, colleagues, anyone you think who might be interested in what we just covered over the last 65 minutes, please share that with them. We'll be sending the link out to you later this afternoon. And thank you for joining us. We've really enjoyed this.